Lupescu, who's vice president at Dimensional Fund Advisors, one of the premier investment managers in the world, managing around $800 billion in assets. He's a globally recognized speaker who has delivered hundreds of lectures and seminars to financial professionals and individual investors on various investment topics, and I've seen a lot of them. Paulo is considered the secretary of explaining stuff because he's a knack for explaining complicated issues in a clear and understandable way. Paulo has been with Dimensional in Santa Monica for over 21 years. Prior to that, he taught at the University of California. He has a PhD in economics and finance from UC Santa Barbara and a BA in economics from Michigan State University, where he competed and coached water polo. Rumor has it that even to this day he's still playing, and more recently he's getting not only in the pool but also learning to surf. Apollo, is that true?
That is true. Hello. Yes, it is true. I'm trying, but it's not easy when you start something after 50. But your brain might think the moves, but the body is just like, no, I'm gonna slow you down.
That is something I've always wanted to try, and there's no way. I just even watching my girls get out onto the board, it just looks hard.
It's fun. It's hard, but it's fun. I mean, I love it. I love anything that has to do with water. Except rain.
Except rain. We were told to remind people, if you want to see it would be best to view this in full view options. So go to the right-hand side up at the top and switch to full view. And if anyone has any questions, you can put them in the chat box. I will try to pay attention to those as I ask Apollo questions. So you ready to dive in?
Let's do it.
All right. So there's a sense of anxiety among some clients who find the pace and changes in the federal government unsettling and unprecedented, leading them to feel that it's different this time, which are the foremost dangerous words in investing. How should investors think about these developments, and how are the markets responding?
Yeah, no, it's absolutely true, and it is. It has been a bit of a roller coaster the last few weeks with the new administration, and I think that what's first of all really important to acknowledge is that a lot of the changes that we have seen do touch on people's deeply held beliefs, their core identity as individuals sometimes, and they tend to be very emotional. And it's legitimate to have these emotions because that's what makes us human. If we see that a particular set of policies are against kind of what we believe, we tend to react negatively. On the other hand, if we believe into those, we tend to be optimistic about it. So right now, as I'm kind of going across the country, I do see there's a group of people who are very anxious and a group of people who are a little bit excited about maybe let's shake up the tree and see what comes out. But I want to start by acknowledging the emotions that come with politics, and particularly with an administration and an individual that tends to be a little bit more polarizing. And I don't think there's anything wrong with these emotions. I think we ought to acknowledge them. And us as investment professionals, what we try to do is acknowledge these emotions and at the same time be very pragmatic when we make decisions about your money. And base those decisions on data and evidence and the fundamentals that drive the stock market. So, Mike, what I'm saying here is that when we look at some of these policies that have been implemented, some of them, and we'll touch on a variety of them, but some of them, like diversity and inclusion, or whether it's releasing January 6th or whatever it is, or supporting or not supporting Ukraine, or getting buddy with Putin in Russia. All of these things are in conflict with our beliefs. And it's like, this is weird. Why are we doing this? Why are we picking fights with our friends? And what the stock market is actually trying to do is answer a bit of a different question, not about these DEI and Ukraine and all that, but rather how are these policies that are coming out of the White House and the administration impacting the profits of companies. And it doesn't have to sound like Gordon Gekko that greed is good. It's just a fundamental premise of the stock market. You are buying ownership in companies. And the value of the ownership depends on what you expect that company to make. So every single day, the stock market's assessing what are the implications of the policies for this administration on the bottom line of companies. And a lot of these, whether it's Ukraine or DEI or releasing January 6 felons, all of these things are emotional, and yet they don't really impact the profits of Coca-Cola, McDonald's, or Boeing, or you name it. It's just not really as impactful to the profits. And there are some policies that might impact, and tariffs. That's certainly one big area that we'll talk about. Other policies, at least they have been the way they've been formulated in the early days, have to do more with deregulation, have to do more with perhaps taxes and other things that might benefit companies. So right now, it's a bit of a whole pattern that we're seeing is that there are some policies that I'm not sure that the businesses like, but there are other policies that, at least in their expectations, might actually help their business. And the market's trying to assess in a pretty unemotional way the impact on the bottom line of their firms of these policies. So that's the first thing that I want to put out there is that not every policy is horrible for these companies. Some might benefit from it, but many of these are more emotional than practically impacting the profits of companies. So that's the first thing that I have to say. The second thing that it comes to these companies in the market, what we tend to see is that these hot button political issues is something that they try to navigate the best they can. And if you go back to the Biden administration, there was a big push to have diversity in the workplace and inclusion. And a lot of these companies started to put diversity, equity, and inclusion departments into their companies. And there was a proliferation of those all over the place. The new administration comes along and says, no, we don't want those. And all of a sudden the companies get rid of them. But again, it's a matter of navigating what's in front of them. And I don't believe that a lot of these companies have very strong opinions one way or another. And look at Google. I mean, Google's a pretty a good example, because if you look at Google and there was that announcement that we should call that Gulf of Mexico now to be called Gulf of America. Well, it turns out that if you open up your Google Maps, it will say Gulf of America, even though if you search for Gulf of Mexico. And so again, I don't know that the company has a strong view on that, but it's just, I'm going to navigate, and if this is what it takes, I'll just get along with that. I'll go along with that. But it's also interesting that if you go around the world, that's not what you see. In the U.S., you see the Gulf of America, but if you go and you use Google Maps in Mexico, Gulf of Mexico. Around the world, it's Gulf of Mexico, and in brackets, Gulf of America. So this kind of points to the fact that these companies are trying to do their best to navigate, and the value of the stock market really comes from what investors expect those companies to make in profits. And at the moment, there's only one policy that really has potentially a negative impact for some firms, potentially beneficial for others, and that is tariffs. And because of that, so far the market in the U.S. has been pretty flat, and it hasn't been really a disaster for the market in any way. So because of that, we're going to wait and see what might come next. But at least as of now, I think the emotional side is dominating the very practical impact on the bottom line of the companies.
Okay, that's great. Thank you. So can we go right to tariffs? Right. So
Yes.
as a candidate, President Trump campaigned for disrupting global trade. And shortly after taking office, he made good on his promises, potentially imposing sweeping tariffs with broad effects for consumers, businesses, and the stock market. What are some possible implications, and what should investors expect looking ahead? Is it smart for investors to take action now, as the economy and markets might be impacted by these policies?
Yeah, absolutely. So let's talk about tariffs, because that has been a major driver of policy and quite often every single day almost in the news. So what are tariffs to begin with? Mike, and I found that sometimes it's good to just start by clarifying what exactly is a tariff, because sometimes people think that, oh, it's a fine, it's a punishment that we impose on foreign producers. And so let's just take a step back, and I'm going to use the example of, let's say, maple syrup. I love maple syrup. And I'm just going to use this as an illustration. I'm going to use companies' names just because it's kind of maybe easy to relate to that, not
Sure.
because in any way. So let's say Costco. I'm Costco, and I want to, put maple syrup on the shelf of my warehouses. So what Costco does, it says, okay, well, where does the maple syrup come from? The vast majority comes from Canada. So they go to a Canadian producer and say, I'd like to buy a maple syrup. And those folks say, great, I'll sell you a bucket of maple syrup for $20. And Costco says, great, I'll take it for $20. And then I have to put on a $4 markup because I need to pay for the warehouse employees, the electricity, and so forth. So now it ends up on the shelf for $24, 20 to the producers, 4 to Costco, and then you pick it up and you take it home for 24 bucks. Now that's in the world with no tariffs. And right now, let's say the government imposes a 25% tariff on all Canadian products. Which is like what's been discussed. So what's going on now? Well, what's going on now when Costco goes to the producer and says, listen, if you sell me that product for $20 because it's made abroad, the government is asking me, the importing company, to collect 25% in value. So if you're selling it to me for $20, I have to collect a quarter of that, meaning $5, and give it to the government, to the U.S. government, the federal government. And one thing that Costco can do and say, listen, because now there's this $5 that has to come out of somewhere. Why don't you lower your price and accept, let's say, a lower price? So this way, I can cover some of the tariff. But the Canadian producers said, well, all the maple syrup is made in Canada. Why would I sell it for less? If you want it, it cost me $20 to make it. It's $20. And Costco, okay, if the Costco gets it for $20, now bringing it in the country, they are required to now pay $5 in this tax, the tariff. So where does it come from? Well, they could say, I'm not going to make any profit. In fact, I'm going to lose $1 so I can send $5 to government, which is not likely to happen. And, the alternative of that could be, well, I'm going to take the $20. I'm going to have to add the $5 of the tariff to the price. And then I still have to add my $4, and then the price would go from 24 to 29, and that means that the entire cost of the tariff is passed on to consumers. Now, when there was a study done when the washing machines went up about 20% in tariff during the first Trump administration, what economists found is that 12% out of the 20 was paid by consumers. So they got passed on to consumers, and the prices went up by about 12% of that tariff was paid by consumers, and the rest of the 8 was split between the producers and the importing company. So where that stands, it depends on the product. Is most of it is made abroad, it's going to be hard for the importer, doesn't have a lot of negotiating power. If a lot of it is made in the U.S., well, then they have a lot more bargaining power, and the producer might have to lower their costs. So it really depends. But by and large, what we see is that a good chunk of the tariff ends up being passed on by consumer, because neither the producer nor the importer has enough room to swallow the additional cost. So just so folks, it's unclear exactly who pays tariff. A lot of it is product by product, depending on where things are made. But ultimately, we do see that from the data that prices would tend to go up. And that's why you hear in the news the potential for inflation means that prices go higher. Now, in the case of tariffs, it's a one-time jump when the tariffs get imposed, and then prices are not necessarily going to keep growing. It's just like you step it up, and then it should stay pretty flat. Now, why would anybody do that? Why would the government impose these tariffs? And it's quite interesting because the tariffs have different purposes. They've had different purposes over the years. If you go back to 1776 and the founding of the country, back in those days, tariffs were an incredibly a big part of the federal budget. In fact, the federal government collected about 90% of its budget from tariffs. Revenue was the main driver of tariffs. We need tariffs so we can generate revenue. And that was really one of the main reasons that we had tariffs. And over the years, we went from about 90%, which was in 1770s, to about 2%. It's less than 2% today. So it's no longer a big driver of government revenue. It's actually a really small fraction of what we collect taxes for the government to spend. Now, the reason for that is that revenue was a big driver, but something happened during the Civil War, at the time of the Civil War, and that was the imposition of the income tax. So we went from having revenue for tariffs from 1776 to about the Civil War to a second stage that happened between the Civil War and pretty much World War II. And the second reason why we had tariffs, it wasn't revenue, but actually restriction. We wanted to restrict trade so we can protect certain industries. And the reason we wanted to protect them was either because we wanted the jobs to stay in the U.S. or because there was a strategic, perhaps defense reason to have that. And that was the second reason, which is restrictions and protectionism that happened roughly between the Civil War and World War II. And after World War II, what happened was a third stage of tariffs. The reason that we had them, which was reciprocity. If you impose a tariff on me, I'm going to impose a tariff on you. But this idea of reciprocity, what's so interesting is that after World War II, it wasn't necessarily about increasing these tariffs, but had exactly the opposite. If you're not going to charge me anything, I'm not going to charge you anything either. And then free trade blossomed. For the past, I would say, about 80 years, we have had a system, a global economic system that has been driven by this idea of reciprocity and tariffs, and particularly reciprocity, meaning that we are going to lower the barriers of trade. And that's where we are today. The idea of reciprocity, low trade, and today, all of these three reasons are apparently back on the table. Like, we want to generate more revenue for the government. We want to restrict and protect certain industries, and we also perhaps want to have some reciprocity. And I think that's kind of what the idea is with these tariffs. But again, when you look at revenue, it's a tiny fraction. It's just not that much. It's less than 2%. I mean, even if you increase it by whatever, it's not gonna be a big part of the federal budget. Protectionism, I think that there might be some strategic reasons to have industries that we produce things at home. But also political reasons, because if you have a group of folks who got hurt by the global trade, they tend to be very, very vocal, and politicians pay attention to those, even though the society as a whole benefits from global trade, and there's plenty of evidence of that. So what does it actually mean? All of this, what does it actually mean? What it means is that as a consumer, it is quite possible that prices might go up, not on a continuous basis, but also like on one time as the tariffs gets imposed, and it depends on the product and where it's made. So it's quite possible that we might see higher inflation in the U.S., and that's sort of the impact for consumers. For businesses, the impact of these tariffs is quite mixed, because some industries might actually benefit from these tariffs as the prices might go up. But the problem is that it's so complicated that if the steel industry for example, might be helped by the tariffs, and there were just recent steel and aluminum tariffs. The trouble is that we see prices going up, and as prices go up in the U.S., companies that buy steel and aluminum, they become less competitive. And what we saw is that because of this, during the previous Trump administration, we had about 1,800 jobs added in steel, but the cost to all of us was about $800,000 per job. Why is that? Well, because Ford had to pay $1 billion more in steel. These washing machines that we talked earlier, well, they're not as competitive now because they have to buy steel at a higher price. So it's a very complicated issue. But again, what I see happening is companies are trying to navigate these times the best they can. And in some ways, they're moving production, maybe not to the U.S., but countries that don't have this tariff, like Vietnam and Cambodia, some other Southeastern Asian countries. And they try to do what they can. The last facet of this is an investor, and I'm going to be quick on that. What does it mean to you, an investor, when you have these tariffs? And there are two things that are hugely important to know. Number one is that the stock market is made out of so many competitive investors that quite often you see the impact of tariffs, the potential impact of tariffs being priced in before the policy is even implemented. So that's one thing that is really important. By the time you hear about the tariffs being implemented, the price of any one company likely adjusted well in advance based on the expectation of the tariff coming. And the second thing is that tariffs are not the primary driver of any one company's performance or the market as a whole. And to illustrate, we talked about steel. If you go to the first Trump administration, there's a company that carries the name of the industry. It's called the United States Steel Corporation. And in the early days of the administration, it basically the stock price tanked. It dropped by more than half, from $40 to less than 20. And then the administration started to talk about potentially imposing tariffs. And on that expectation, with no clarity, just the expectation that tariffs might come, perhaps that was why you saw the stock price for U.S. steel just skyrocket. But there was no tariff. There was just an expectation. And it turns out that in March of 2018, the administration did impose tariffs against foreign steel producers. And at that point, as an investor, say, wow, we got tariffs, that's got to be good. And the seductive narrative is, let's pile money into this. Well, if you look at what happened between March of 2018 and when the administration lost the election in the November 2020, U.S. Steel lost the vast majority of its value, despite actually having these tariffs behind it. There are too many other variables that might have driven this down. And again, you can look at the first Trump administration, year after year, Mike, we saw tariff, and all this talk that we had. And during those 4 years, the U.S. stock market, the S&P 500, did quite well. It went up about 80%. If you had started with $1 in 2017, you would have ended up with about 180 by the end of 4 years, which is a really nice growth. And the country that we actually try to impose tariffs and punish them for their behavior, whatever the case might have been, was China. And if you look at China, the recipient of these tariffs, well, it turns out that during the same exact 4 years, the Chinese stock market actually outperformed the U.S. market. It did better. Why? It's, again, tariffs are not the primary driver of any one stock or the market as a whole. Too many other variables. And because of that, again, it's an emotional issue. Companies might have to figure out their supply chains or whatever else. I just don't see tariffs as something that ought to be a reason for an investor to trade.
Okay, thanks for that great explanation. Really appreciate it. Before we get to the next question, Apollo, can we answer a question from the audience?
Yes, absolutely.
The question is, what does the U.S. government do with its newfound tariff revenues?
Yeah, so the revenues coming from the tariffs, in the context, the big context of the overall budget, it's a very, very small fraction. So it's not adding much. So if it's about 1.8%, which is roughly, last time I looked, about 1.8% of the budget is coming from these tariffs. If you, let's say, impose any tariffs and it increases, it might go from 1.8 to 1.9 or 2 point something. It's still a very small fraction. So what's the government going to do with this? Well, the first thing is that the government is running a very big deficit. And what it means is that the government is spending a lot more money than it collects in taxes. So this tariff revenue supposedly can close that gap a bit. And by how much? It's just you're taking a huge a dam and you try to plug it in with a little bit of plaster. It's not going to be that much. It might be a little bit, but one of the things that could happen with the additional revenue is close the gap between how much we spend as a country and how much we collect in taxes.
Okay, great. Thank you. All right, so next question. While the new administration is pursuing different economic priorities than the last one, how much attention should investors devote to initiatives that may either benefit or disadvantage specific sectors and industries? Is it advisable to adjust investment strategies to capitalize on these developments or to mitigate against potential losses?
Yeah, for sure. And we talked about this. I think that this idea that tariffs or other policies help or hurt, in my opinion, are not the main driver of should not be the main driver of somebody's portfolio. Because as we looked at the case of U.S. Steel, if you had followed that seductive narrative, that I should pay attention to what the government does and invest in companies or sectors that might benefit, that would have been just a recipe for disaster, because that did not work out at all. But what about paying attention to some things that might actually benefit the company or an industry? And let's take an example from the Biden administration, because when they came in, a big initiative was green energy and sustainable energy. And the industry that really benefited the most was solar panels and sun power, because that is sustainable, and there are tariffs against producers abroad. There are all kinds of support that the administration tried to do to create just a successful environment for these companies to thrive in the U.S. So if you go back to those early days, it turns out that I wanted to put solar panels, not because of the administration, because I want to save some money here. And one of the bids that I got was from a large company that is actually part of the S&P 500, that is called First Solar. So just out of curiosity, at the beginning of this year, I wanted to know, what was the impact of the support onto this entity, First Solar. So when I actually look at the stock price and said, what if I invested $1 at the beginning of the Biden administration? By the end, it turns out that the dollar would have turned into about 180. Which is so interesting, because it's roughly the same growth as during President Trump, in 4 years in the White House. But this is specifically to an industry that was supported by the Biden administration. So perhaps there is something to be said about having the government back you up, because that's a really nice growth. Not quite double, but we did very well in First Solar. Now, Michael, what I also remembered is that I wanted to be a smart shopper, and I actually got a competitor, and I think at the time it was at the Costco, and the competitor that I went to was to get a bid was Sunrun. Very similar, same idea. They do solar panels, and interesting enough, if you had invested $1 at the same January 1st, 2021, as with First Solar, the dollar in Sunrun would have turned into precisely 13 cents. A huge drop, more than 80%, roughly about an 80% drop, and yet it's the same exact business. It's the same industry. So, how come one company really benefited perhaps and the other one got hurt? And to me, kind of goes to that point that I mentioned earlier, is that these government policies are not the primary driver of a company's on a stock performance. You have customer service, you have the product itself, you have the strategy, how they execute it. You have a lot of other dynamics in the market, and I would not say that the primary driver is the government policy. Now, one can say, and I was in Oklahoma not too long ago, and somebody said, yeah, but at least they had the backing of the government. Like, you look at fossil fuel, and during the 4 years of the Biden administration, that was really something that was frowned upon, and nobody really wanted to support it. And in that case, should you be wary of industries that don't get the support? And out of curiosity, I wanted to see, for example, Exxon. Which is a large company in the business of fossil fuels for the most part. And what's interesting is that during the same 4 years of the Biden administration, $1 invested in Exxon would have turned into $2.60. So quite significantly more. So it is interesting that the idea that I should pay attention to what's in favor, what's not in favor, is not really backed up by data. I mean, how did Exxon do better than all the solar companies, despite the push that the government had towards green, and Exxon not having any supposedly friends in D.C. for those 4 years? So because of that, we don't suggest that should be a trading strategy for any investor.
It's always interesting to me that people often think like one thing will have such a outsized impact, and the world is a complicated place. There's lots of stuff going on everywhere in the world, and And yeah, it's I guess we like to tell ourselves stories to make things easier or to explain things, but a lot of stuff is not easily explained and it's complicated.
You got it. Like that's a great way to put it. We want to simplify the world and kind of like say if this then that. It's a lot more complicated than that. Don't fall in that trap because that's a great way to put it. It's too complicated. Don't That's too simple of a story and it's not accurate.
Right. All right. So the president indicated during the campaign a desire to reduce various taxes without detailing significant spending cuts.
Right.
Combination that would likely increase our already substantial national debt. Can you discuss the origins of this debt burden, how we arrived at the current situation, and whether our fiscal trajectory remains sustainable even before considering these new tax proposals?
Yeah, absolutely. And I think we touched a little bit on the idea of deficit. And what a deficit is any single year we spend more money than we collect in taxes. And when you add up the deficits that might happen year after year after year, when you sum them all up, you get what's called the national debt, which is the overall debt in the country. And to kind of put a number to that, Mike, if you look at the beginning of the year, January 2025, and I'm going to use some rough numbers totally in the ballpark. As a country, we owed something in the order of $36 trillion. That's how much we owed as a country, $36 trillion. And when President Biden came in the White House in January of 2021, that number was roughly about $28 trillion. So over the course of the 4 years of the Biden administration, we increased the debt by about 8 trillion, which means that we roughly increased it by about $2 trillion per year. That's kind of been the increase in debt. So per year, we spend roughly about $2 trillion more than we collected in taxes. Now, that's what I was saying. The tariffs are not really going to make a big dent in this, in my opinion. Now, if you look at the first Trump administration, January 2017, when they came in, the level of the national debt was a little below 20 trillion, but let's just make it easy and say it was $20 trillion, give them some credit. And if you look at those years, what it basically meant is that we added roughly about $2 trillion per year. Roughly the same, no difference. It was roughly the same during the Biden and the first Trump administration. And then if you go back to January of 2009, that's when President Obama came in the White House, we had roughly about 11 trillion in debt, which means that over the Obama administration, 8 years, we had roughly about $1.1 trillion per year. So we have been stepping up the debt over the past two administrations, very consistent, about $2 trillion per year. And what's interesting about this is that people are very focused on that number, 36 trillion. We owe a lot of money. I would argue that that number is a little bit is not the main concern in a way, because when the way the government borrows money is they go to Mike and say, Mike, hey, listen, you want to lend me $1,000 for, let's say, a number of years. And when it's time for them to repay the $1,000 to Mike, they can come to me and say, "Hey, Apollo, do you want to lend me $1,000?" And they can take my $1,000, give it to Mike, and they can roll the debt over and over and over again. So the amount of the principal, in a way, can be rolled, and whether that's right or wrong, the government has been doing this, and it's not really that difficult for the government to do this. There's one thing though that they cannot avoid, and that's so interesting, because even though they can roll the debt, there's one thing they have to do. They have to pay interest on the debt. And that's key here, right? Because the interest on the debt, in my opinion, is the true burden of the debt. It's not the number itself, but rather the interest. How much does it cost us as a country to pay interest on the debt? And I kind of mentioned to you today that in 2025 we owe roughly about $36 trillion. And what was interesting for me to see is that in 1991 we owed roughly about $3.6 trillion. And I picked 1991 because it's a very clean, growth. We increased the debt tenfold over the past 34 years. And that's kind of what's so interesting is that we've had this incredible growth, tenfold increase over the past 34 years. And what's interesting is that when we owed 3.6 trillion, that's in 1991. If you look at the interest that we paid relative to the size of the economy, also called the gross domestic product or GDP, we spent about 3.1% of the value of the entire economic output in paying interest on the debt. And that was back in 1991 when we owed 3.6 trillion. Now we owe $36 trillion. How can it, how much can it be now that we owe so much more? Turns out that the Fed actually keeps track of this number, the federal outlays for interest payments relative to the size of the economy. And it turns out at the beginning of the year, that number stood at 3.1%. It is identical. It is absolutely identical. It's not any different than it was when we owed a tenth of the debt. So how can that be? Well, there are two things that make a difference. The first one is the size of the economy. Everything grows over time. The number of people, the number of dollars in circulation, the size of the market, the size of the economy. So it shouldn't be surprising that the level of the debt also increases over time. But the second big one, which is so important, is looking back at the time when we accumulated this debt. We started in 2009 with 11 trillion, and now we're at 36. So we added 25 trillion out of the 36 over the past 16 years or so. And the reason that it's so interesting is that the bulk of this debt was actually incurred at a time when the interest rates were rock bottom, incredibly low. And in fact, what's so remarkable is that if you had looked in 2021, that number, instead of being 3.1, was actually 1.4%. 1.4% just 4 years ago. What's been interesting is that since then, we saw interest rates going up, and that is the reason that we're kind of back to this 3.1. To me, like, folks, what I want you to focus is more on how much does it cost us? And the big question is, what's going to happen to interest rates? If they continue to grow, well, that's going to be very different than if the interest rates kind of start coming down. Now, how is the market assessing whether or not this is a sustainable debt? And it's actually a very clear signal, because when investors are lending money, not just to the U.S. government, but to anybody, to you as a consumer, anytime there is a loan being made, the interest rate that gets paid is commensurate with the risk of not getting your money back and not having a repayment. And if you look at the U.S. government and you look at the borrowing cost, how much they pay for 10 years, those are the interest rates for a 10-year U.S. government bond, is about 4.4%. And how does that compare, for example, with other entities that want to borrow money? Well, Mickey Mouse, Disney also wants to borrow money, and they have to pay more. Instead of 4.4, they have to pay 5.5. They would love to pay 4.4, but the market's saying, not so fast, Mickey. You got to pay me more, because I don't think that your risk is the same as the U.S. government. You go down the road, and great American company, Ford, they have to pay more. Macy's, great department store, they have to pay even more. And to me, that is the signal. The signal is, how much are investors accepting to lend money? Because every borrower wants to pay the least they can. But there is a balance, because the investors are saying, I'm not going to give you the same money. And the U.S. government at the moment, and it hasn't changed for, as far as I know, as far as I've been an investor for 20 plus years, the U.S. government is still considered to be the most robust borrower, despite all the difficulties. And if there comes a day when the markets might not believe that the debt is sustainable, what's likely going to happen is that you're going to see a higher rate. And one of the examples out there is Brazil. Brazil now has to pay a much higher rate than all of these entities, because the perceived risk associated with their debt. What's the main story here? The debt has been growing, and it has been growing at fairly constant pace over the past two administrations. And the true burden is not the number itself, but the interest that we pay as a country. And the interest, we got really lucky with a very low period. What's going to happen next depends on where the rates are going, and that's the issue with the debt. And the last thing is that the markets are assessing the how sustainable the debt is every single second of the day, and it's reflecting this in the relative interest rate that the government has to pay. And as of now, markets are sending a very clear signal. They believe that the debt of the U.S. government is sustainable.
That's great.
At the moment.
At the moment. Always interesting to see what that 10-year yield is. And it's 4.2, 4.4%.
Yep.
Could we pause we have two different questions from viewers.
Yes.
And hopefully they won't be too hard or too much of a curveball, put you on the spot here. First question, what's your opinion about the likelihood of stagflation occurring? And if you think it's coming, what does an effective investment strategy look like?
Yeah. So stagflation, basically, it's a combination of two evils, evils like quote unquote. Sure. There are two things that are not pleasant to us as consumers and to the economy. One is inflation. And inflation is something that means that prices, not in any one area, not eggs, because eggs might be driven by not having, the chickens having an issue with the bird flu, whatever the case might be, but prices as a whole in the economy going up. And when that happens, you have inflation, prices go up and up and up. And that's something that people don't necessarily like. I mean, people want some stability in prices. So that's one thing. High inflation is one issue. The second issue is what's called recession. And recession doesn't really have a clear economic definition. The popular way of thinking is that if the economy doesn't grow 2 quarters in a row, well, that's a recession. That's not really it. A recession is only declared by a group of 8 academics who are part of the National Bureau of Economic Research, and they don't always follow that. Last recession lasted 2 months, so theoretically they could not have been a recession because it wasn't 2 quarters, and that was during the pandemic in 2020. So recession, basically, what it really that word stands for is that the economic activity in the U.S. declines, unemployment goes up, things are not pretty. So when you have a combination of the two, that is typically called stagflation. And we really have not had stagflation in the U.S. Since the early 80s. That was the last time that we had a recession, in the early 80s. And we also had a pretty high inflation. Now, what should you do then? Well, I think that from a stock market perspective, I don't really believe that ought to be a change in strategy, because when you work with Yardley and you have a financial plan, that financial plan accounts for your circumstances, your needs, and accounts for the fact that we might have situations like this happening in the country. The portfolio, the plan is built to withstand these times. How? Well, if you look at inflation, for example, if prices go up, well, who's picking up the additional money? Like, you look at the pandemic and the prices went up and up and up. Well, who's picking up the additional revenue? Well, it turns out these are companies that quite often trade in the stock market. So their revenues are going up and their value is going up. And that's kind of what we saw during the pandemic years and the inflation years. So stock market, in my opinion, is a good way to stay ahead of inflation over the long run. Again, because conceptually you can think about these prices going up, the revenues of companies are going up. So in a way, that's conceptually a good way to stay ahead of inflation. The second thing that he can do as part of the plan is have some money allocated not just to ownership in companies, which is the stock market, but also lending through bonds. and they're all kinds of bonds, and some of these bonds are actually could be really well insulated against inflation. Some of these bonds are called Treasury inflation protected securities. So the government is giving you basically an interest rate that is kind of stated in the contract, but then the value of the bond adjusts with inflation. So if we had inflation, instead of paying, let's say, 10% on $1,000, which is $100. If the inflation moves up 20%, well, now the value of the bond is 1,200. So you get 10% of that, which means that you actually are immunized against inflation every single day. So there are all kinds of instruments that you can put together. What about recession? Well, it turns out that interestingly enough, the recession and the markets don't move in lockstep, because the recession has to do with that economic activity that is happening at the moment. But the stock market is really about the future, because what I mean by that, I don't know if you remember a strip of film. My daughter started shooting black and white film, and I used to process this as a kid. And it kind of got me thinking that when you think about the economy, what I want you to think about is a scene, a frame, one snapshot of what is going on today with prices, economic activity. All of this is just one snapshot, one frame, one scene of what's going on today. That's what the economy is. It's about today. It impacts your paycheck today. Stock market is about ownership in companies. And the ownership that you will have is not just this year, but many, many, many years down the road. So whereas the economy is a scene, a frame, the stock market is a much longer running movie. And you have to play it all the way to the end, because this is a very long running movie. There are companies that have been around for over 100 years. Exxon has been paying dividends to shareholders over 110 years. So it's a very long running movie. And the reason I'm saying this is that sometimes you could be in a recession, and you could hear a lot about, the recession, and we're going to run into a recession. Markets tend to be forward looking. And what they're seeing is like, we're in a recession today, but they're looking down the road and playing the movie for years and years down the road. And you shouldn't be surprised if at times the recession might look really horrible, and yet the markets are going to do well. In 1980, I mentioned that year, it was a terrible economy. I mean, we had huge unemployment, big inflation, everything was horrific. And as an investor, you're kind of saying, wait a second, why would I want to be in this market when I have stagflation? Stagflation, I had both inflation and economic downturn at the same time. It just doesn't seem to be the right idea. Remember that the stock market, it's a very, very long running movie. And what it does is saying, okay, it's cloudy right now and it's raining, but I see the sun coming up. Well, I'm going to get sunblock before the sun even gets there. Or the opposite, if it's sunny right now and you see the clouds coming, it's going to actually grab an umbrella, meaning that it's forward looking. It prices things in even before they come. And because of that, in 1980, the last time that we had stagflation, what's remarkable is that the U.S. stock market went up by about 32%. 32% up in a year when we had both inflation, high inflation, and big economic downturn. So because of that, again, keep in mind that your plan was built to withstand situations like this, even stagflation. And as an investor, you're better off staying disciplined rather than try to say, let me get out because recession might come or inflation. That's not the right strategy. The right strategy is having the right plan through the right allocation.
I saw that answer, Apollo. When you said early 80s, all I could think it was like in 82 or 83 or whenever the bull market took off and interest rates started coming down. It's a great time to own stocks and bonds for a long time. Time. One other question, what impact do the Doge attacks on Social Security have on financial planning? Do we know what's going on there?
Yeah. So let's talk about that for a second, because I mentioned to you this idea of the debt and the deficit, and I'll tie into the Dodge and Social Security. And you kind of saw that over the course of these two administrations, they're pretty much identical. They're not very different at all. It was about $2 trillion per year, despite having two completely different political views, completely different administration and priorities, and yet they pretty much stuck to the same number. Why is that? It turns out that when you look at the government spending, there are two different types of government spending. One, it's called mandatory. And the reason it's called mandatory is because there is a law that was put in place and the government is required to fund it. It has no option to get around it unless it changes the law. And unless it changes the law, it's automatically going to get paid. And the two biggest programs are Social Security and Medicare. So the federal government and the administration, nobody can change this because these programs are on autopilot. Dodge, nobody can touch them because they are required by law. And unless the law changes, they can't touch that. And somebody can be cynical and say, well, they've done other things. No, you can't do this. It's just like off the reservation. You can't do it because any court in a minute would strike that down. So they're not touching at all. Dodge is not touching at all these mandatory spendings. The second category is called discretionary spending. And that's something that we as a country decide to spend money on. Building highways. There's no law saying that we have to build highways. NIH funding cancer research. There's no law saying that. Funding university research program. There's no law saying that we have. We just choose to do it. It's not mandatory, but rather discretionary spending. And what Dodge has been looking at is more of this discretionary spending. Now, have they really been able to make a big dent? What I see happening, at least from what I'm seeing, is that there's a lot of noise, but it's minimal impact. Yeah, USAID, which I worked for the State Department at some point in my life, and I'm a huge believer in the benefits of foreign aid, and is not just for the benefit of other countries but ourselves. It turns out that program, if it gets shut down, it's emotionally impactful to me. At the same time, I'm looking at how much did that make a dent? When you cut $1 billion or $2 out of $2 trillion, it's 0.0% nothing. In other words, it's more of the emotional impact that it has on us. Dodge hasn't really made any big inroads. Like they said, we're going to cut all this money, and they even put a target of $55 billion. Sounds like a lot. When you have a deficit of $2 trillion, $55 billion is not that much, and what they've actually accomplished is close to $2 billion, which is like it's very low. When you hear about these layoffs, it's in the thousands, and for sure that's not pleasant. It's hurting people. Some might say, well, that's actually good because we're making the government more efficient. Well, put these numbers in context, folks. There are 2.4 million federal employees. When you have a few thousand who are no longer employed, that's a really small percentage. I would say that in any firm out there, there is a turnover that's likely a lot bigger than this. And I'm not, again, saying it's good or bad. I'm just saying put some context. You hear about the Dodge layoffs. You have 2.4 million, and percentage-wise, the people who are no longer working are a very, very, very small percentage of that. It's just a lot of noise. I think a lot of grandstanding, a lot of this, but the impact, whether on cuts or all that, is different. And when it comes to Social Security, I don't want to give you a warm and fuzzy feeling for no reason, but I'm very, very I'm quite certain that there is no plan at the moment to cut those, because then you'd have to change the law. It's only the lawmakers who can change the Social Security. Dodge cannot touch it, legally speaking, and there are no challenges to this because they never even tried to get to close to that, because there's no winning there.
Okay, that's great.
Plus, you would lose a voting block that would just devastate. I mean, it would be, imagine that you touch $1 in Social Security, what the entire retiree population of the country is going to be up in arms. They're going to have forks and they're going to go out there. It's not. If they're going to touch anything, that's not it. That's not
a good voting block. One last thing, we are running up against time. Do you any final thoughts? Anything you'd like to convey?
Yeah, I mean, I do want to say, folks, that I want to go back to that emotional side that we feel very strongly, and it's in our face. It's every single day. The reality is that I don't want to be political at all. I'm just saying that as a country, more than half voted, and I think that it was not unknown to them. It's not like they didn't know what they were doing. I think people, many people, more than half the people wanted to try something different. It's not like they didn't know. It's not like everything that's happening right now was very clearly spelled out during the campaign. You can't say I didn't know they was going to do that. Of course, everybody knew, and perhaps it's give it a try and see what's going to happen. And the reality is that in about a year and a half, there's another election, another big election, and if things really don't go well, it'll be a very clear message that the population will send. This is not working out. And that's what happened the first time around, is that by midterms, it completely flipped, and it was a very different dynamic once that flipped. So I think it remains to be seen. I want to be very open-minded, and I want to be, balanced in the way I think about it. And right now, it's so emotional, and the way you put it, the pace of change is great. I would just, give a little time. The markets have not reacted horribly. It's roughly flat, particularly if you have a global portfolio. It's just emotionally, it's hard to untangle. But keep in mind that you are buying ownership into companies, and these companies will find a way to make it work, irrespective of the state of the world. And I'll give you maybe the ultimate example in my mind, which is not one president, but one time in history. And that is talking to my mom, World War II. I mean, she was like, son, that was bad. That was horrific. And I was curious to see, as an investor, how would that have played out for you? And Mike, if you looked in September of 1939, you saw that Germany invaded Poland. And then you have a client who comes and says, hey, Mike, this is not good. This is likely going to be another war. This is going to be horrific for the planet. Everything is going to be upside down. I don't want to be invested. And somehow you tell this client, you should probably stay invested. I know there's going to be a war and millions of people are going to die, cities destroyed, but you should stay invested. They'd be like, are you nuts? And then if you fast forward to August of 1945, when Japan surrendered, and you ask the question, well, how would it have played out? How much money would you have made or lost if you stayed invested during the 6 years of World War II, the most devastating period by far in modern history? Well, it turns out that $1 invested in September of 39 by the end of the war would have pretty much doubled. Despite all the things that happened in the world. And the U.S. got attacked in December of 41. So if you look at the full years of war, 42, 43, 44, and 45, in every single year, the U.S. stock market delivered just outstanding returns. So when that happened, I was like, how come? How is it possible to have this outcome when the world is in such turmoil? And that was truly different. That was truly different. And then I remember that when I lived in Michigan, I used to visit just with my girlfriend at the time some elderly couples and have dinner with them on Sundays. And I remember this lady telling us about World War II and how terrible it was for all these car makers who didn't have customers. But then she also said something that I revisited recently, which is how those companies navigated those times. And what's fascinating is that the way that they navigated them is that Cadillac, when they couldn't sell cars, they made tanks. They put the engines in a tank, and I'm not sure it had leather seats or power windows, but that's what the Cadillac looked like back in those days, and they sold it to the government. And, when Ford couldn't sell their Model T, they built airplanes, and when you see Build Ford Tough, well, the toughest Fords ever built are not the F-150s, but rather the tanks. So to me, it speaks of this idea that companies will find a way to navigate what is put in front of them, irrespective of the state of the world, irrespective. And we saw this during the pandemic. when the whole economy was shut down, well, Marriott laid off workers because there are no trips to their hotels. The cruise lines lay off of people, and then when things came back, they rehired them. That's the nature of the market. So my, the reason for my hope is not really just a blind faith in markets. No, it's my faith in the free markets and the companies who every single day try to be resilient and have ingenuity. And to me, that is the reason for my optimism: the ingenuity and the resilience of companies, individual companies, and us as investors. We're just along for the ride.
Yeah, that's great. Apollo, thank you so much for taking the time with us today. And for all our viewers and listeners, I really appreciate you spending the hour. Thanks so much. We're going to shut this down now.